have John Michael Durrant. He's BMO Nesbitt Burns Vice President of BMO Estate Insurance Advisory Services. He is one of our teammates who is a part of our group and works very closely with our team, the MIO team. JM has 25 years experience helping real estate investors, including many owners and developers, high net worth clients, implement their insurance-based planning strategies to complement and enhance their wealth. Tax and estate planning goals and objectives are met through John Michael's help. Please, John Michael.
So today I'm going to talk about insurance needs for the real estate investor. I'm in a fortunate position working at BMO Wealth to work with a lot of clients who have built very, very large real estate portfolios. So what I'm going to try to do today is take you through a little bit of background. I won't spend a lot of time here, and talk about insurance tax rules, following Jenny at a high level, insurance options, so a little bit on product, what insurance is, and then try to loop it back into how insurance fits into the various stages for real estate investors, and then talk about why insurance should be looked at as a unique asset class and why the clients that we work with end up taking advantage of the opportunity to use life insurance as part of their overall wealth, tax, and estate planning. So from a tax point of view, one of the questions that I get asked all the time, further to some of the questions that Jenny would get, is if I pay for insurance premiums, is that tax deductible? And the simple answer is no, unless it is used as part of collateral assignment for a loan. So a lot of our big real estate transactions, if they're dealing with a financial institution, there could be a requirement that insurance is put in place as part of that financing arrangement. Some other benefits from a tax point of view: in certain types of insurance contracts, all the investment growth that takes place is tax-free. And from a death benefit perspective, when insurance pays out, it also pays out completely free of tax. So you're going to see there's a lot of tax flavor to insurance. A lot of people don't understand all the tax rules about insurance. Quite often when our clients will go to their tax advisors, unlike going to Jenny, when they say, should we buy life insurance? They don't get a depends answer. Quite often they get a no. And I'll say that's because a lot of them don't understand the unique tax benefits that insurance can bring to the table. In a corporate setting, we do a lot of work with clients with corporate assets, because it may make sense in their situation to hold their real estate investments inside a corporation. Is you get some unique benefits. The big one is that insurance, remember I said, pays completely free of tax. Well, when it pays out free of tax into a corporation, it creates a credit to what they call the capital dividend account. And that's a notional account that allows money to flow out of a company without any tax. So you can see I'm going to say tax a lot in this session. So from a product point of view, as I said, I'm not going to spend a lot of time in this. There's a whole bunch of different insurance concepts out there. I'm just focusing on the life side. The two main ones that would be applicable to a real estate investor would be term insurance and permanent insurance. And think of term insurance as a pure protection vehicle. It's inexpensive. It's for a short-term need. Think of permanent insurance, and terminology on the street for different types of permanent insurance would be universal life, participating whole life. Again, I could have a whole session just talking about those products. You would all fall asleep. So we're going to skip over those really, really fast. But the permanent insurance, that's where we spend most of our time helping clients, is looking at insurance on a permanent basis. It does come with normally a higher entry point from a premium point of view, but it is where we structure things for our longer term planning. So Jenny alluded to clients who have held real estate for 30, 40 years. You know, a lot of you in this room may end up in that same situation where you buy real estate today and it could be in your real estate portfolio 20, 30 years from now. So we're looking at insurance on a longer term, and it's the type of product that we use when we're doing our advanced insurance planning with clients. So when I look at insurance, I really break it down into three buckets: protection, wealth, tax, and I should probably add estate to that. So insurance is a hedge against risk, a wealth creation tool, and a tax planning tool. And I'll stress the tax, because most of our insurance-based planning, it is all tax driven. So I'm going to break down the phases of a real estate investor into three buckets. Not going to spend a lot of time, but think of it as startup, growth, and mature. So when we meet with clients, they're somewhere in that range. There may be other categories you would put in there, but I'll say as a startup, you've just bought your first investment property. Growth, you're on your 5th, 6th, 7th. Mature, you have 20, 30. We just met with a client who had 60 and had some of them in their portfolio for 30, 40 years. So if we're looking at insurance from a risk, wealth, and tax, there's various ways it's going to impact a startup, growth, and mature phase. So obviously, the startup phase, there's a real need for protection. So these clients are looking for debt. So they may have borrowed to put their first real estate piece in their investment portfolio. They're worried about protecting their family. They're looking for peace of mind. If something happened, if it's a husband and wife, a couple scenario, what if one of them passes away? Is there a way to retire the debt? Is there a way to make sure the family's intact? So that's where we'd be looking at term insurance. It's cheap, it's inexpensive, it's for a defined period of time, easy to understand. The growth phase, that's where we start to look at insurance from a protection and a wealth perspective. So still there may be debts, outstanding loans. You're still continuing to try to grow your real estate portfolio. Maybe now starting to grow your personal wealth as well. You've paid off some of those properties. You're looking for other investment opportunities, maybe outside of real estate, maybe in the equity market, like Stephen had spoken about. You're looking at things like, should I own this personally? Should I own it corporately? Great tax discussion to have with Jenny or your tax professionals that you deal with. And again, here we're looking at insurance. Maybe there's a need for term insurance. Maybe there's a need for permanent insurance, longer term planning. And this is where we may start the discussion with clients as well to add leverage to the insurance structures. So insurance can be really, really simple, term insurance over here, and we can make insurance very, very complicated, but maybe even more efficient. So there are strategies out there where clients will look at adding leverage to their insurance structure. So I'll give you an example. We have a client, they love real estate. Everything they earn goes back into real estate. Sorry, Stephen, there's no equity portfolio is going to be there ever. But there's good cash flow. They do sit on a little bit of cash, but they want that money available to grab that next real estate investment. So what you can do is you can structure an insurance contract in such a way that you make a deposit into a permanent insurance contract, normally whole life, and you can actually then go to the bank, a financial institution, and borrow that deposit into the insurance contract back. So I'll give you the example of the one we're working on right now. They're looking at $300,000 a year of deposit for 10 years into an insurance contract. They need the insurance because they know that they need it for long-term tax planning, but they don't want to tie up that $300,000. So $300,000 times 10 means a commitment of $3 million. They want that $3 million available for the market, the real estate market. So what you can do is you can go to a financial institution, borrow the money back. So put the money into the contract. They'll lend you back your $300,000 using the policy as collateral for a loan, normally assigned, so you get to deduct the insurance premiums, and you can put that $300,000 back into the real estate market. And if you do all the right things from a reinvestment perspective, you then may be able to get interest deductibility. So that scenario is they build their real estate portfolio, they build their insurance portfolio, they need the insurance because they know there's going to be a very, very large gains tax. Their intention is to hold the properties till death, so deemed disposition at death. And it's a great way to have a little bit of both worlds. But again, that could be a presentation all on its own. The growth or the mature phase, this is kind of where protection, wealth, and tax all come together. So at this stage, normally we're dealing with older clients. These are clients who've had portfolios that have been in place for 30, 40 years. They now are starting to think about how do we transfer our wealth to the next generation? How do we deal with that deemed disposition? Are there other planning techniques that we should be looking at to mitigate probate, to ensure an efficient wealth transfer? So we get into discussions with those types of clients. How do you structure your holdings? Are there ways you can play with title to get around probate? Should you be looking at alter ego trusts? Should you be looking at insurance? Should you be looking at a corporation, maybe involving a freeze? There's lots of different conversations that you can have with your professional advisors. In this space, normally we're always looking at a permanent insurance structure. And most of it revolves around this. And Jenny, I took this right off your presentation. So, cash flow is a problem. So clients who are heavy real estate investors, liquidity may be an issue at death. We're working with a client right now that has $60 million of real estate, and they have about a $10 million tax liability. They're in their 70s. We're meeting with them, their children, and their grandchildren are in the mix. So we're looking at how do we mitigate that tax? How are we going to address this issue from a tax point of view? And obviously you've got options. You can save for that. You can borrow for that. You can sell property, which is a worst case scenario, not ideal. So what I did is I just put together here a sample, a couple both age 60, the tax liability at death under the current tax regime I've just assumed to be $1 million. Could be higher. So this is just fictitious. And again, if we know there's $1 million tax liability looming, sell, borrow, insurance. And quite often in my world every day dealing with insurance, because that's all I do, is the first question or the first comment that comes to us is, insurance isn't a good investment. I'm better just to keep the money in the bank, and I'll just save for that tax liability if I'm able. And I think earlier today, Aaron said that GIC rates are around, Stephen, 2, 3 for 5-year? 2? If you can get that. So this is a little chart that we quite often will use with clients. So what we want to do is take it back to an investment. So who would be happy if they could get a 6 or 7% GIC right now? That would be pretty good? Okay. So with insurance, we can create a structure that can replicate that. So I'll focus in on that number right there. If you can't see it, it's 7%. And the far column over here says pre-tax GIC equivalent rate. So what this tells us, if the client were to pay an annual premium for $1 million and it were to pay out on the second death of husband and wife in this example, what would you have to earn in a traditional investment in a GIC if you were just going to save the same amount of money? What would you have to earn every single year on that insurance premium to have it grow to $1 million? So if these clients live to 95, they would have to go out and buy a 7% GIC every single year for 35 years to end up with the same $1 million. I didn't put it in here, but the actual cost, the premium for that structure on a level lifetime basis, it's about $15,000 a year. If it were to pay out in 30 years, so they're 90, second death, then it's a 10% GIC equivalent return, meaning you'd have to save that $15,000 at a GIC rate of 10% or 5% after tax to end up with the same $1 million. So what you have to do is think of insurance more as an investment vehicle than an insurance product. And this is how wealthy clients that own a lot of real estate will structure their affairs, because the returns on the insurance look very, very attractive to them. So I'll say insurance is a unique asset class because it can offer stable returns. Internal rate of return, like we looked at, is very attractive. Depending on how you structure the insurance, you can accumulate funds inside certain insurance contracts that are exempt from tax, then ultimately also pay out tax-free as part of the insurance structure. It has a tax-free death benefit that is payable immediately. So when the tax man comes knocking on that deemed disposition on that $1 million tax bill or $10 million tax bill, we're working on one where we're looking at a $50 million tax bill owing on the final return based on the real estate holdings. If you need to, you can access the values, and you can do it inside a corporation. So if it makes sense to incorporate, a lot of our clients, if they do incorporate and they're not flowing all the money out, if you remember Jenny's slide where it showed how much money is in the company, if you, let's say you pay that low rate of tax, a lot of our clients accumulate cash inside their companies, and sometimes it makes sense to structure the insurance inside the corporation. So the corporation would be the owner, the beneficiary, and if it works and it makes sense, we can use the low tax corporate dollars to pay the insurance premium. I'm just going to give you a corporate example. This is an actual case for a real estate client that did incorporate. They have excess cash inside their company, and they were looking for a place to park it. They were going to actually hold cash to pay the tax liability, and we said, oh, hold on a second. Why don't we look at the opportunity to look at insurance as a better vehicle to fund the tax liability, get money out of your company, and maximize the wealth transfer? And they were like, nah, we've heard the insurance story before. We didn't like it, but they didn't look at it as an investment. And remember, like a lot of you in the room, if you love real estate, you love real estate. And what hooked them was the ability to pass on more wealth to their family so they could buy more real estate. So I'll give you the example really, really quick. So the example would be $50,000 a year into an insurance contract. It's structured on a fully guaranteed basis, and by that I mean the deposit amount of $50,000, the duration of 10 years, and the death benefit are fully guaranteed. So there's absolutely no moving parts to the insurance. And basically, that insurance structure would buy them $1.7 million of insurance death benefit inside the company. And what we do is we compare it to what if you took the same money, could find a 5% GIC. Remember, Stephen said there's 2 or 3. Let's just say you could get 5, just to tell the story. How much would be left at the end of the day, net out of the company, to their beneficiaries? So if we went with the $50,000 a year at 5%, on the far side of the slide in yellow, that would be worth $750,000 after the assets are paid out of the company, and I've assumed the corporation is wound up just in this example. The insurance on the other side is worth that, $1.7 million. So at death, the insurance proceeds will pay into the corporation. They are going to then be received tax-free. At that stage, they have a full credit to their capital dividend account. So that means that $1.7 million can come out of the corporation completely free of tax. So $1.7 million for their family to go and buy more real estate, or $750,000. My 13-year-old isn't the smartest, but I'm sure he would think the $1.7 million would be the better way to go. And that's just simply effectively using an insurance strategy. So just high level, the benefits of owning insurance inside a corporation: you get tax sheltered accumulation, so it's not subject to corporate investment income tax rates. If you are dealing with small business tax rate and you're worried about the implications once your investment income starts to exceed $50,000, it is a great way to tax shelter money, so it's not going to be impacting the tax rate, the passive investment income rules. Premiums are paid using corporate dollars, sometimes the lowest tax dollars, and again, proceeds when they pay into the corporation pay in tax-free and create a credit to the capital dividend account, which then can be paid out to Canadian resident shareholders on a tax-free basis. So it's a very, very tax-efficient vehicle. And as we were hearing from Jenny, the government quite often is not being kind to tax rules. If gains taxes are going to go up to 75%, the government gives us a sandbox to play in, so take advantage of it. All the insurance tax rules are Section 148 of the Income Tax Act. So why do real estate investors buy insurance? Many of them look at it as a unique asset class. They find a purpose to the insurance that complements their goals and objectives, what they're trying to do, what they're trying to achieve, and it doesn't matter if they are in the startup phase, the growth phase, or the mature phase. It can also help deal with minimizing taxes or offsetting them, or creating a liquid fund to pay that tax liability. If the policy is set up on a personal basis and you have named beneficiaries, proceeds of insurance contracts can also bypass probate. Lots of people do a lot of tax planning just to avoid probate. Sometimes maybe not the best planning to be done, but clients hate paying tax. So if you can get around probate, that's a great feature. Maximizes the wealth distribution to family members, Also is a great planning tool for estate liquidity needs. It's instant cash, so it's available immediately to pay a tax bill. We're working with clients, they own apartment buildings, and about 10 years ago, the gentleman's dad passed away, and they had to scramble to come up with the taxes owing. It was $5 million. They ended up going to BMO, who provided a loan to help offset those taxes. When we met with them, they said, can you please help us and put us in a position that our kids are not going to have to do that scramble like we did. So they are looking at structuring right now an insurance policy inside their corporation where they own their apartment buildings to make sure that when they pass away, their kids are going to receive a lump sum of cash that can then offset those taxes. Because they also looked at it as a unique asset class, they also realized that, if things change, the plan is to hold on to those apartment buildings. But if things change and they sell the apartment buildings and realize the tax while they're alive, they still realize that the insurance is a good investment. So on his chart, when we looked at the IRR, at his age of 95, based on the structure, it was a 9% GIC. He's like, that's a good rate of return, even if we're not dealing with a tax liability at that time. But I think at the end of the day, why real estate investors buy insurance, especially the wealthy ones, it's the peace of mind that's brought to the table. It's knowing that there's a big check mark in that box that a lot of them have worried about. It's simple, it's effective. I wish we didn't have to call it insurance. If anyone has a better name for it, let Isaac know and he'll share it with me. But it's something to consider. It can be a great fit. If you can identify the purpose to it, and if you care. We have one client we're working with. We've shown them that the tax liability on their real estate is going to be $12 million. They don't care. My kids can deal with it. So you can be on the spectrum of I don't care, or you can be on the spectrum of I'm going to plan for this. So I had 3 real estate client meetings last week, and I knew this presentation was coming up. So I asked them, what would be one word of advice that I could share with the room? Anyone guess what that is? Other than buy more real estate? Was plan early. On the insurance side, they said, make sure you explain, make sure clients understand when they're saying no to an insurance strategy, really what the benefits are before saying no. And then I'll say there's maybe a third thing they said is make sure you surround yourself with experts. So tell the audience, surround yourself with the right people to give you the best advice. And obviously, I have the pleasure of working with Stephen and his team. They provide great service to their clients. I'm just one of the specialized planners within BMO that they have access to. So my specialty is insurance. We have in-house tax people. We have estate and trust people. The tax people are not there to replace what Jenny does, but to give high-level guidance and then make a referral out to either their own tax people or recommended tax professionals by us, like Jenny and her team at her firm. So with that, I'll say thank you and open up the floor to any questions.